right? 15th of March, ending the trading week, and I only took 3 trades. Now, we had 1 win, 2 losses, which is still net profit, but is not really what I expected on price. It's not really what I expected for myself. And in terms of progression, yes, we gained 45 pips. Yes, we used a 1% risk. I used 0.5% risk on this trade because we knew that it was a less conviction trade. And that's completely fine. I'm adhering to the rules, I'm adhering to the systems, but I just feel it's one of those feelings you get. I think everyone in the trading industry will have this feeling of, okay, you still made profits, you're still in the green for the week, but you feel like you could have done better. You feel like this isn't good enough for the amount of work that you have put in. That's exactly the way I'm feeling right now. I started the week off absolutely strong, and then we kind of just fumbled the rest of the week, and it was because of the same mistake, which I will go over in a short second. First things first is I want to go over the Monday trade, which is the huge dub that I took. And this was based off the 30-minute candle open, advantage to re-break the highs. Everything here was just absolutely top notch, A+ quality setup. We took the re-break of the highs, you saw support come up, and it was just clear traffic for price to run. And if we look on the time frame, this is what the 15 re-break the highs. That's your 30 re-break of the highs there. Got in here. We had risk off. My original risk off area is at the top here. However, when we look to the left of our screen, we did see there is actually a little bit of a level that price action needs to respect. And then we decided to close off risk a little bit early. So we moved break even once price action gave us a closure above this line. But even that wasn't really necessary. Price action tapped our original risk off area, but that turned out to be the complete resistance. That's why I ended up closing the position because I was a little bit too aspirational that I felt on that trade. Price action ended up closing right out where I decided to close out my trade and then reject right off to come right back down to break even. If we look at the actual trade position that we would have wanted, it would have been a break even outcome. However, price action still tapped our original level and it would have just completely ran. So we would have been stopped out at break even. And then once we got stopped out at break even, price action decides to flip at this area. So again, it's an observation that I'm looking to make again, that how can I still get into positions and still try and get a risk off area, or at least limit risk, without getting stopped out, without having my position not pay me? And it's still something that I'm working on. I think the focus still is, well, the focus is definitely still going to be on understanding that my key priority is following the systems. The key priority is to gain as much data as possible, as much consistency as possible, and making sure that my mental mindset and the discipline to actually enter trades that are actually validated remains the top priority, remains the actual focus. So Monday's trade, I've got no concerns with. It was absolutely phenomenal. Yes, we could have ran it. If I didn't run it, if I didn't run it, it would have been a break-even outcome. So for me, I think Monday was actually a little bit of a luck opportunity, because I did technically dynamically manage my trading position with the manual trade closure at plus 190 pips. Now for Wednesday, Tuesday we didn't have any trades. There wasn't really too many opportunities in the market. The week actually has been pretty dry. The market conditions trading this week have been pretty bad. Um, it's just been ranging, and the moves when they happen is very, very fast, and I don't anticipate them, which is again something that we'd have to look at. If next week provides you with the same type of price action behavior, you'd be looking to kind of take the exact same things, which is trying to understand the characteristics and identify what price action is doing before a push. So I took one trade position on Wednesday, and the plan execution was followed. The lows were broken again on the 4 hour before taking the rebreak at a highs on the new 15. But the only thing that I could have avoided was to actually wait for a 5-minute candle closure of the 15 candle, or something to at least give me a candle closure confirming the range of support has been respected. Um, but actually, I think all of my requirements were met. We had the current range, we had the liquidity area that got grabbed. That was a, well, I want to say fake out, but actually when you look at the candle, there is still a wick. You got the first candle closure above, so you're looking at taking an entry here for price action to start pushing up, which unfortunately for me, price action stopped me out, grabbed more liquidity for then price to flip up. So for me, the liquidity area that I marked out wasn't aggressive enough, or I didn't account for that much aggressiveness on a liquidity grab. So for me, if I'm placing my stop loss on this trade position, it would have to be much wider. But for me, when I looked at this trade position, if I was to increase my stop loss, you'd be looking at a negative risk to reward trade, which for me doesn't really make too much sense, especially if I'm only focusing on risking minimum 1% on each trade. So that was Wednesday trade position. Now for Thursday's trade position, again was a loss, the same type of entry. I had the retest to the 1 hour lows and a break, and the plan was followed. I did not get a 5 minute candle closure above, but we did get the rebreak at the highs, which is what gave me conviction on this trade position. The time frame, I think this was the 30 time frame, yes it is, gave me a bullish hammer, inverse hammer, which typically tells me price action should give you a wick fill. But in this case, the daily was pretty bearish. We looked like price action needed a reversal, but it wasn't mandatory. So this was kind of just me trying to piece everything together, trying to get into a position on a buy to catch some form of reversal, have some form of an advantage point. Relatively low risk. Again, like I said, risked 0.5% on this trade position, and unfortunately, it didn't go my way. So those were the 3 trade positions that I did take. Again, Wednesday and Thursdays can be avoided for next week if we focus more on the liquidity, if we focus more on the confirmations and getting confirmations with closures, with candle closures above the range to respect the support, respect the resistance. Just textbook things that we need to just keep eyeing on and making sure we don't lose the focus on them. So for the weekly roundup here, the losses come from failing to wait for enough liquidity, so focusing on understanding the characteristics of how liquidity gets grabbed is very important, and identifying a mirror before any potential opportunities is the way to go. Although we have been following the plan this week, there are scenarios that a position could have been avoided if we actually know exactly what price is mirroring first. So what we typically do on the trading charts, if we go here, because I'm currently doing a back test, is we'll mark out the current ranges. You'll mark out the ranges, and then you'll look for a mirror on price action to the left of your screen. Now, this isn't really a fantastic example unless you look at this liquidity grab for price action. You'll be looking at grab of liquidity in this area, and you're looking to mirror pretty much the entire range all the way up. Okay, looks like I fucked that one up. So you're looking at pretty much getting the entire range or copy of mirror on price action, which is this move here. So you'd mark it out and you'd look for an entry. Now, in this case, the 1 hour time frame opened up 1 in the morning. This is just a back test example. You'd look at pretty much the exact same move, have a little bit of a gap to make sure price action doesn't just wick you and then miss the wick and then come straight back down. You want to make sure you're definitely securing the profits. And then let's just see. I mean, yeah, price action would have just tapped you straight out. It made sense in the 4 hour time frame. Yeah, 4 hour time frame gave you a respect, broke the lows, so liquidity got grabbed. You'll be looking at an entry on that 4 hour candle. If we can get lower time frame confirmation, you got the 30 that gave you a pullback here at 030. You got the retest of the lows on that 4 hour candle open, right? Price action came up, started respecting, grabbed liquidity. You'll probably be looking at rebreak at the highs because you've already got confirmation price actions respecting support. So this would have been a really, really nice trade. Your stop loss would be placed below those lows, and this trade position would be a 1 to 2.63 trade risk to reward. So that's what I mean. We mark out the box of the mirror on price action, and this past week we know what the narrative is. We know roughly what price is trying to mirror, but we didn't really mark out the exact price action point that we're looking to mirror. And if we have the exact mirror, then we know exactly what to expect. And that's why we know exactly where to place a stop loss. And that's, again, priority for next week. So know that if price action doesn't give you a clear read on price action, you do not have to take the position. I think Wednesday and Thursday's trade position, if we went into it and go through it again, I wouldn't really take those same trade positions because we didn't have a very clear read on price action, especially with that daily time frame. In my eyes, when I looked at those daily time frames, what I was looking at was price action could push you down, could push you up. It looked like you were ranging. So when I was looking at these candles here, it was very uncertain for me to say where the strong drive would be. That's why the daily time frame wasn't very strong in terms of giving me a signal or a confirmation. That's why we only focus on the 4 and the 1. And I think that kind of did take a little bit of a toll on the accuracy for me. Anyways, we're entering the 3rd week of March. The risk 1 to 2% per trade, which was mandatory, we followed. Following the systems and ensuring entry validation right before entry was followed. So all of these things was good, but the quality could be questioned because some entries could have been vetted more thoroughly before an entry, a proper break, and liquidity grab than a solid closure above the range. It was still a performing week, and I should still be happy with the small progression that I have made. The goal is to still get the funding, so let's not waste any time here. So again, it's the same thing. We force 1% risk. We force on focusing on entering flow state, limit the distractions, and protect the energy. When I come to the desk, I should not be distracted with other things. I should be looking at only vetting for quality positions and understanding that it's rinse and repeat. You follow a 4+1 checklist system. You've got the current range, you've got the liquidity area, you've got the mirror on price action, you've got the narrative, and you've got the break of the low of the highs of the current candle. And that comes with closures. That comes with narrative being built on the lower time frame. That is still remaining the goal for the third week. I find it extremely embarrassing for me to sit here and say that I've had one evaluation account for more than a year now, and I still haven't moved anywhere. I'm still break even on that trade account, and there's absolutely I really don't know what to do. So I'm educating myself more on how to get more funding accounts, how people stack accounts, what futures are, because I know with futures and between CFDs, which is what I'm currently trading in futures, CFDs give you a fixed drawdown limit. So no matter how much you make, the drawdown limit gets larger. Whereas with futures, the more you make, your drawdown limit still stays the same because there's a daily reset. That's by far the majority of my understanding is predominantly on the risk rules. But again, I really have no clue. I'm going to educate myself more, but that about rounds up my entire week. We still came out 45 pips in the green, and that resulted in only a $3.25 because we did use variable stops since we're only risking 1%. And that again, the 1% risk, it doesn't matter if your stop loss is 20 pips. If your stop loss is 20 pips, then your lot size is going to be larger. You're still risking 250 odd dollars. And that's pretty much a wrap for the week. The focus we've gone over. I know exactly what my clear intentions are for the new week, and we'll see again where that's going to give our progression for our results next week.